Hey there, it's Orphe Divounguy, the co-host of the Everyday Economics podcast. Exciting news! Check out my new weekly column at thecentersquare.com. Join me as I break down complex economic trends in a way that's easy to understand for everyone. Check out the column every week and stay informed about the economic forces shaping our world. Be sure to subscribe to the Everyday Economics podcast and visit thecentersquare.com today.
Welcome back to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network, and you could subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We're recording this episode on Monday, June 24th. And join me, as always, the great one, Dr. Orphe Divounguy, PhD economist. Dr. O, you have a column that's running each Monday at thecentersquare.com. And in that piece, you look at the economic stuff coming up in the week ahead. What's on tap this week?
Well, first, a number of Fed officials will speak. Bowman probably will talk about financial regulations in the banking sector. Christopher Waller, I believe, is going to be, again, talking about monetary policy. I mean, the bottom line is, here's why it matters. It matters because they all have their kind of expertise and they all have kind of their views on what's going on with the U.S. economy. They also see data before we do, right? They see data from different parts of the country, right? But ultimately, I think they'll likely stick to the script. Which is basically the rhetoric. The Fed's rhetoric hasn't really changed, right? Recent inflation data, retail sales came in softer than previously anticipated. They'll probably play it safe, which is what we saw reflected in the summary of economic projections, right? In the dot plot, we saw they had PC inflation penciled in at 2.8%, the median for this year, 2024. And I think they're going to continue to stick to that, right? That maybe we'll get one rate cut. That's what the dot plot showed at the end of the year. Maybe one at the end of the year, maybe one at the start of next year, if you listen to Christopher Waller, right? So that's not really going to change anything this week.
No surprises coming. The Fed governors are going overseas to break news.
No surprises from any Fed official, governors, or even president of some of the Fed banks. You're not going to be surprised here. We're going to get some data. The big surprise, hopefully it won't be too much of a surprise. It will be coming from the data, the PCE price index, coming out on Friday, I believe. And that's going to cause a lot of movements in the markets, along with the expectation that the labor market will continue to soften further, that the savings rate should begin to rise. Household consumption should ease further, resulting in less pressure on core prices. And so what should we see, right? We should see the savings rate increase. We should see the core PCE price index ease a bit from the events in April. And of course, we should see it ease. The expectation that it will ease on an annual basis from 2.8% last month down to 2.6% this month. And I think that's the big news of the week. We're probably, if we see any deviation from that forecast, you can bet you're going to see massive swings in yields and mortgage rates on Friday. So that's what I'm going to be really, really, really attentive to. This whole, the PCE price index, the personal consumption data, personal income and personal consumption data at the end of the week.
So when you're saying swings, let's get into the detail of that. What do you think is going to be moving and how far?
Well, it really depends. If markets expect it to ease, you're probably going to see the yields on the 10-year treasury continue to fall, right? They've been I think the yield's been easing for 2 or 3 weeks now, as the concern has really shifted after we got that really low CPI, PPI inflation print. The concern has really been shifted to, is perhaps the U.S. economy cooling more rapidly than previously anticipated? After a hot Q1, could we now see inflation really move faster to 2% and maybe even below 2%, right? So the concern has shifted to, hey, maybe the U.S. economy is cooling very rapidly. In fact, there was a note by the Goldman Sachs research economist that circulated around last week, which I posted on my LinkedIn. And they had this beautiful graph of the U.S. beverage curve. And the curve really kind of gives you the relationship between the unemployment rate and job openings. As labor demand eased, we saw job openings easing, right? We saw job openings falling rapidly, the excess job openings falling, disappearing. And basically their note was saying, look, we're at a point on the curve where further easing in labor demand could result in an increase in layoffs, right? And so far we've seen a slowdown in hiring, but potentially, right, we could be at a point where we see the unemployment rate start to increase a little bit faster because of an increase in layoffs. And I think just them putting that out there, and we saw lower than expected inflation data. We saw lower than expected retail sales data. All of that is hinting that maybe the higher for longer interest rate environment is finally showing its effect.
Yeah. I'll tell you, just in terms of real world stuff, over the last week or so, I've had a couple of conversations with friends of mine who work in supply side jobs in manufacturing, right? And so they're producing materials that go to manufacturers to aid them in the production of the stuff that they create. And they've, in uniform fashion, have said that orders have slowed down. So I think I think what you're saying is tracking. I think that there are some breadcrumbs there. What else do we have to look forward to this week? What else is on your punch list today?
Yeah, I think that sums it up. But really, like for me, given that I work in my primary focus is the housing market, I wonder if we're going to see some easing in terms of mortgage rates. But ultimately, we want the labor market to hold up, and we don't want it to crack, because ultimately people without a job can't get a mortgage in the first place, right? And so as everybody was cheering for mortgage rates to decline, we got to be cheering for this expansion to continue. I mean, so far so good. I think we're going to be in better shape than most people anticipate, is my feeling. We're seeing the easing, that a moderation that was necessary, that was a bit delayed. We're getting closer to the 2% target. That's good news. The Fed is going to have to recalibrate policy and bring those rates down. I think perhaps maybe sooner than later. There are a few headwinds in the horizon, and given things are cooling pretty fast now, maybe we're going to get that rate cut. Market's still expected to come in September. Maybe we are going to get it right around election time this year.
Well, I appreciate your thoughts as always. Make sure you take a look at Dr. Orphe Divoungui's column each week, Monday, at thecentersquare.com. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.
Hey there, it's Orphe Divounguy, the co-host of the Everyday Economics podcast. Exciting news! Check out my new weekly column at thecentersquare.com. Join me as I break down complex economic trends in a way that's easy to understand for everyone. Check out the column every week and stay informed about the economic forces shaping our world. Be sure to subscribe to the Everyday Economics podcast and visit thecentersquare.com today.